Have you ever felt a subtle unease, a quiet question lingering in the corners of your mind, even after a meeting with your financial advisor? That familiar ache, this yearning for clarity amidst the financial fog, is often born from conflicting market information and the deep fear of making a costly mistake that could jeopardize the very future you are striving to build. For many, the journey towards sustainable wealth feels like navigating a dense forest without a compass, relying on guides whose true path remains, at times, obscured. Perhaps you've felt the emotional weight of seeing others appear to succeed while you grapple with uncertainty, or the quiet sting of past disappointments when trust was misplaced. These feelings are not a weakness, they are a calling, an invitation to a more profound engagement with your own financial destiny. Today, we will stand together at the threshold of deeper understanding, cultivating discernment to restore your sense of value and identity in this intricate dance of capital. We will explore for profound questions designed to illuminate the true nature of your financial guidance and empower your choices with the quiet strength of informed conviction. This is not about chasing fleeting trends or superficial advice. It is about seeking intimacy with data-driven truth, about forging a path towards sustainable wealth creation, guided by informed decision-making. We are uncovering the hidden truths behind wealth accumulation, inviting you to challenge the consensus and find your unique edge. Too often, we enter these advisory relationships with a vague sense of hope, rather than a clear strategic framework, driven perhaps by a silent fear of financial loss or an unspoken feeling of investment inadequacy. This often leads to what we might call a silent partnership, where the true mandate of your advisor and your own role within it remains unexamined. This unconscious delegation of critical thinking can prevent true financial mastery. Benjamin Graham, the sagacious teacher of value, once reminded us that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This profound truth extends to your advisory relationship. Are you truly weighing their advice with critical insight, or are you simply voting for their popularity, their perceived success, or the comfort of conventional wisdom? Our journey today is to equip you with the strategic questions that will transform you from a passive recipient of counsel into an active, data-driven partner in your own financial future. What if the most powerful tool in your financial arsenal is not a new investment, but a well-formed question, asked with purpose and clarity? Don't just invest, understand the why behind every decision. That silent frustration, a quiet ache, often stems from an incomplete or superficial financial education, leaving many ambitious investors unable to truly discern a robust investment philosophy from mere marketing jargon. It creates a feeling of investment inadequacy, a subtle doubt when attempting to evaluate complex financial advice. We are often led to believe that an advisor's strategy is simply asset allocation based on a generic risk questionnaire. But this is a common distortion, a simplification that bypasses the true essence of strategic finance. A genuine strategy is a deeply considered, historically validated framework for capital deployment and risk mitigation, a profound understanding of how wealth truly compounds and endures. The shattering expectation for many is realizing that numerous advisors, despite their polished credentials, operate on a highly reactive or consensus-driven approach. They often lack the rigorous, data-backed investment philosophy that truly resilient wealth building demands, frequently concealing this void with broad market commentary and reassuring platitudes. This is where our first profound question emerges, a quiet but powerful inquiry designed to penetrate beyond the brochure and demand your advisor's core investment creed. To truly discern their guiding principles, we propose a three-step technique rooted in the fundamental principles of strategic finance. First, ask for their personal, articulated investment thesis, backed not by generic statements, but by their own rigorous research and convictions. Second, demand the data-driven rationale for why they believe this specific philosophy works across various market cycles, not just during periods of calm. How has it weathered the storms of history? And third, inquire about their process for managing disconfirming evidence or adapting their core beliefs when the world shifts. A truly intelligent investor and their advisor must possess the humility to evolve. Think of it this way: a ship's captain needs a clear nautical chart and a deep understanding of ocean currents, not just a daily weather report. Your wealth, your financial vessel, needs an advisor whose philosophy is a profound deep-sea chart, guiding you through known and unknown waters, not merely a forecast written in sand on a windy beach, easily washed away by the next tide. Is your advisor truly charting a course, or merely reacting to the waves? Have you ever felt that philosophical wound, a quiet sting from questioning the fundamental fairness or logic of market mechanisms, especially when it comes to the advice you receive? It often arises when investors realize that fiduciary duty doesn't automatically equate to perfect alignment, breeding a deep distrust of financial authority regarding subtle conflicts of interest. There's a common distortion, a comforting illusion, that assuming fee-only or fiduciary status completely eliminates all such conflicts. Yet, this often overlooks the subtle yet powerful incentives that can still steer advice, perhaps towards certain products, specific platforms, or simply the ease of management for the advisor's firm. The counterintuitive truth, often hidden in plain sight, is that even seemingly benign compensation structures can subtly encourage decisions that optimize for the advisor's business model. This might mean prioritizing asset under management growth, fostering specific vendor relationships, or streamlining operational efficiency, rather than strictly focusing on your optimized, long-term, net of all costs wealth accumulation. This is not to imply malice, but to acknowledge the inherent human tendency to respond to incentives. Our second profound question, therefore, guides us to dissect, unpack, and reveal the true cost and incentive structure. This is a symbolic exercise, an act of quiet revelation. Ask for a detailed breakdown of all revenue streams the advisor or firm receives, directly or indirectly, from your assets. This includes platform fees, fund kickbacks, or referral bonuses. Crucially, ask for this to be expressed as a total percentage of your portfolio, not just a base fee. This holistic view unveils the complete picture, allowing you to see the full landscape of their compensation compass. You might feel a mild stress, a touch of cortisol, as you challenge these beliefs and seek this level of transparency. This is natural, a sign of engagement, but it need not hinder your empowered, data-driven decision-making. Understanding these hidden currents is like an experienced sailor knowing exactly how the wind fills each sail, not just relying on the captain's word. It's about truly understanding the forces at play, allowing you to navigate your financial waters with a clearer, more confident hand. Is your advisor's compass truly aligned with yours, or is it subtly pulled by other magnetic forces? The overwhelm from an endless stream of financial data without clear synthesis can leave us feeling inadequate, even outmaneuvered. This fertile ground often breeds cognitive dissonance, a quiet discomfort when market narratives clash with the careful plans we've tried to lay. It's a profound internal struggle, a mind's minefield where our own psychology can become our greatest adversary. We often mistakenly believe an advisor's primary role is simply to provide market forecasts and allocate assets. But is that truly enough? The deeper, more critical function, often overlooked, is to actively help you, the investor, navigate your own inherent behavioral biases. These silent saboteurs, confirmation bias, anchoring bias, loss aversion, overconfidence, they whisper doubts and temptations, pulling us away from our rational, long-term vision. The shattering expectation for many is the realization that most advisors lack a systematic, data-driven framework for identifying and mitigating your specific behavioral traps. They often treat market volatility as an external event, a storm to be weathered, rather than an internal psychological challenge for the investor, a tempest within the mind. So, our third profound question, a mental healing model rooted in insights like those from Daniel Kahneman's thinking, fast and slow becomes essential. Ask your advisor, what is your explicit process for identifying my potential behavioral traps? How do you plan to intervene or provide structured decision-making support to keep me aligned with my rational, long-term plan, especially during market downturns or when the siren song of chasing returns grows loud? Consider the poignant story of Jesse Livermore, often called the Great Bear of Wall Street. His profound market insight was legendary, yet his downfall often came not from a lack of understanding the market, but from succumbing to his own emotional traps, his personal biases. Your advisor should be a steadfast guard against your inner Livermore a wise counsel helping you master your own mind's minefield, not just a market prognosticator. Are they truly equipped to help you master yourself, or only the market's external movements? A silent distrust of financial authority often stems from receiving advice that feels anecdotal, perhaps based on gut feelings or generalized market commentary. This can lead to analysis paralysis, a quiet overwhelm from too much conflicting data, simply because the investor lacks the foundational quantitative methods to truly evaluate it. There's a persistent myth that financial news directly translates to actionable investment insights, or that a compelling narrative about a company or trend is a sufficient substitute for rigorous, data-backed analysis. Yet, the genuine underlying mechanisms of complex financial markets demand more than a captivating story. The counterintuitive truth, which often goes unexamined, is that many sophisticated recommendations are built on generic models or qualitative assumptions that haven't been stress-tested against historical data or rigorous quantitative analysis specific to your portfolio's objectives and risk profile. It's like being shown a beautiful building but never seeing its structural blueprints. Our fourth profound question then invites us into the heart of data deconstruction, unpacking the quantitative core of advisory recommendations. This is a three-step strategic finance technique designed to empower you. First, ask for the specific quantitative metrics used to evaluate recommended investments. We are talking about concrete measures, Sharpe ratio, Sortino ratio, drawdown analysis, valuation multiples. Second, demand the back-tested data or empirical evidence supporting their chosen strategies, efficacy over various market cycles. How has this approach performed through different economic seasons, not just the sunny ones? And third, inquire about their model's underlying assumptions, its limitations, and critically, how they account for black swans or unexpected market shocks. Society has often distorted the image of the independent, data-driven investor by promoting reliance on charismatic gurus rather than fostering a critical, analytical mindset within each of us. This journey empowers you to demand the architectural blueprint of their advice, not just admire the facade. Are their recommendations built on solid, verifiable data, or are they merely a compelling narrative woven from the winds of market sentiment? We are seeking the quiet strength of numbers, the undeniable logic that underpins true value. The fear of financial loss is most acute when market conditions shift dramatically, isn't it? This fear is often exacerbated by a feeling of inadequacy, a quiet sense of being outmaneuvered when one's portfolio isn't prepared. It leads to a profound, unconscious cognitive bias influencing investment decisions, subtly pushing us to avoid difficult discussions about downside risk. There's a common distortion, a comforting illusion, that diversification alone guarantees safety during severe market downturns, or that simply holding for the long term is a sufficient strategy. Yet, true resilience demands a deeper understanding of your portfolio's specific mechanisms for both defense and offense. The shattering expectation for many is the realization that most advisors' risk assessments are often superficial. They frequently fail to provide specific, data-driven scenario analyses that simulate your portfolio's performance under various historical and hypothetical market crises. This oversight leaves hidden vulnerabilities unexplored, vulnerabilities that generic models often miss, only to become painfully apparent when the market turns. This brings us to our final, profound question, a practical transformation for your financial dialogue. Demand your advisor provide detailed scenario analyses for your specific portfolio. This is about stress testing your resilience. Ask them to model performance through historical bear markets, like the 2008 financial crisis or the dot-com bust. How would your portfolio have fared? Inquire about periods of high inflation and rising interest rates. And crucially, ask about sector-specific shocks that could impact your holdings, more than just what it might do. Ask how your portfolio is structurally designed to mitigate these precise scenarios. Consider the fatal mistake of those who seek actionable, rigorously data-backed financial strategies at the wrong time, waiting for the storm to hit before asking how the ship was built. A truly prepared portfolio is like an intelligently designed fortress, its resilience tested and understood long before the siege. This reflects Benjamin Graham's timeless emphasis on the margin of safety, a buffer built in during times of calm, not amidst the chaos. Is your portfolio truly a fortress, or merely a fair weather shelter? We must understand its strength now, before the winds of change truly howl. We have journeyed together through the quiet landscape of financial relationships, unearthing the profound questions that redefine your engagement. True empowerment, we have seen, comes not from passively being told what to do, but from intimately understanding the why and how behind every financial decision. This profound shift transforms any lingering feeling of investment inadequacy into the quiet strength of financial mastery, a deep knowing that resonates within your very core. By actively engaging with these critical questions, probing your advisor's core investment creed, navigating the hidden currents of their compensation compass, confronting the mind's minefield of your own biases, and demanding a rigorous data deconstruction of their recommendations, you begin to shift. You move from being a passive passenger in your financial journey to becoming the co-pilot, armed with clarity and conviction, holding the reins of your destiny with a firm, informed hand. This is not about suspicion, but about sacred discernment. It is about fostering an intimacy with data-driven truth, ensuring that your path to sustainable wealth creation is built on solid ground. Warren Buffett often speaks of an inner scorecard, measuring yourself by your own standards, by the depth of your understanding and the integrity of your process, not by what others think or by external metrics alone. This profound wisdom applies directly to your financial decisions. Are you truly confident in the foundational understanding behind your advisor's recommendations, or are you deferring to an external score, a perceived authority that you haven't fully interrogated? Are your choices truly yours, born from informed conviction, or are they echoes of another's voice? The ultimate goal, the quiet aspiration, is not simply to have an advisor, but to forge an informed partnership. It is a relationship where your thoughtful questions drive transparency, where they validate strategy, and where they ultimately lead to sustainable wealth accumulation through truly independent, data-driven choices. This is the quiet revolution of understanding, the gentle reclaiming of your own financial sovereignty. It is about are building a wealth that reflects your deepest values, a wealth cultivated with wisdom and integrity. As you move forward, carrying these for profound questions in your heart and mind, remember that true wealth is not merely accumulated. It is understood, it is nurtured, and it is defended with clarity. What new truths will you uncover when you begin to ask, not with fear, but with the quiet courage of an intelligent investor?